Good afternoon, everyone. I hope you're well, and I'm really excited about this next segment on the agenda. The global bond market, in a word, is large. At the end of 2022, and I'm sure it's grown since then, it was valued at over $130 trillion. Around half of that value is composed by the world's two largest economies, the United States and China. And over the most recent period, particularly post-COVID, debt levels and debt overall has increased markedly. For example, the US government, between the end of 2019 and the end of last year, added $10 trillion to its debt load. That's a lot of rand. As a matter of fact, you can choose your currency. It's a lot of whatever currency it is. Just don't go to like Zimbabwe ZiG or something of that nature. Fixed income assets, of course, are sensitive to policy rates and the inflationary outlook. And as some central bankers once tried to make us believe, we know that inflation was not transitory, and it's proven to be very sticky. And interest rates, belatedly by some of these central banks, were raised in accordance. And in line with that raising, interest bills increased significantly. And that's filtered through to the payment pressures and finances that governments face, that companies face, and that individuals face. There may be some reprieve. Yesterday, the first G7 nation cut its policy rate. And I think before we came on, there was reference to the ECB. Within the next 2 hours or so, it's widely expected that they will begin to cut rates as well. But this is an important asset class. It provides a relevant and weighty indicator of risks and required return by country, by sector, by company, and filters down into individuals. And in this session, we'll explore issues that are pertinent to the class. And joining me is my expert panel, who have all been introduced and their names appear. But maybe for the sake of formality, I should repeat their names. Anthea Gardner from Cartesian Capital, Bassam Nawfal from Alpine Macro, Kieran Curtis from ABDRN, and Adam Furlan from 91. Gentlemen, lady, welcome and thank you for joining us.
Thank you.
Let me jump straight into the first question, and I'd like to address this question to Bassam and then Anthea. We've had almost half of the year go by, and if you look at what's happening in the bond market specifically, what does it tell us about how investors are interpreting the outlook going forward? What are they thinking about? And is there alignment between what you're seeing in market performance and what central bankers are telling us? Bassam?
Right. So we've actually been seeing yields back up for most of the year. And that's because we've had bumps along the disinflationary road, right? So investors are sensing the hesitancy of central banks to proclaim mission accomplished when it comes to inflation. And by the same token, central bankers are sending the message to markets and saying, hey, do not expect aggressive easing cycles given the stickiness that we're witnessing in inflation. And so we've seen a lot of the sizable rate cuts that were discounted earlier this year, late last year, being priced out. So that doesn't mean we should expect the resumption of tightening cycles either. And the upshot is that the peak in yields is probably in, and that they're going to remain range-bound for a while longer until that disinflationary process reasserts itself.
Interesting. Okay, so a couple of bumps along the way. Anthea, what is your take?
I have to comment on Bassam's comment about the central bankers messaging us as the investors. So most of the people in this room will remember Chris Stals was our Reserve Bank governor just kind of before South Africa became a democracy. And I wasn't there, but I have it on good authority that he would take his files with him on a Friday night, go home, have dinner, pour himself a glass of wine, and then make a decision about interest rates. And, and depending on how late in the evening or early in the morning it was, he'd phone his colleagues and say, this is what's happening. And then on Monday, they would tell the rest of the market. So things have changed a bit, you know.
Just a tad.
And it's true that I think we overanalyze what the central bankers are trying to message to us, and the central bankers know this. So they will give us the message they want us to see. The local markets in the last 5 months is kind of flat, very volatile, but most of the volatility really has been around elections, which is disappointing. And of course, the other thing I need to say is that the last 5 months have proven that markets are actually not always right. You know, we saw we saw the FRA curve expecting rate cuts, or 3 rate cuts,
yeah.
And then suddenly in April it jumped, and potentially there was a little spike in the FRA curve, so that potentially we could have a rate hike, 25 basis, and everyone, of course, had an absolute panic.
Yep.
And so I think that's probably the most important. That's the important message: is as investors, you have to be there all the time and watching, because things change, and central bank messaging must be taken with a pinch of salt, perhaps.
Perhaps. But hopefully it's data-driven and not red wine-driven in terms of decisions. I think the comment you made, Anthea, is a good segue for a question that's on my mind, and it's around elections. And I know that politics form part of the agenda today. And undoubtedly, I suspect, I wasn't here, what was highlighted is that a significant portion of the global population is voting. We've just had an election in this country. We'll see what the coalition looks like, hopefully soon, and that it will be stable. The world's largest democracy, India, just had its results announced, and unsurprisingly, the BJP, Modi's party, secured the most votes, but probably surprising for him, he got a bit of a bloody nose, because his party lost seats relative to the previous election. But elections do matter. And we see that playing out in the markets. I think before we got on stage, there was some banter around what was happening and what might be influencing it, and politics again came into the discussion. So, and Adam, I'd like to address this to you. How do you anticipate possible election outcomes, and you choose the advanced economies that you want to, or the emerging markets, to impact on the fixed income market going forward?
Yep. Thanks, Herman. I suppose to paint it with quite a broad brush, you know, election outcomes just bring uncertainty into any financial asset or any financial market. In the case of fixed income, that's quite the same. And you know, you mentioned those 3 elections we've just had: Mexico, India, South Africa. Mm-hmm. All 3 delivering unexpected outcomes. And you know, that uncertainty needs to be priced in terms of risk premium into fixed income markets. And looking forward, when you're looking at any fixed income market where there is an upcoming risk event, an upcoming election, you should be expecting a premium priced into that market as to compensate you for that uncertain outcome that's coming. So that's one way to think about it in terms of risk-adjusted carry, volatility priced into those markets. And you know, then taking a step further, what are the macro implications of that outcome? You know, that's really where the rubber hits the road. What impacts a fixed income investor? What are likely policy changes as a result of this election outcome? Is it in terms of, you know, macro-prudential policy? Is it in terms of other larger, wider reforms that are going to impact that economy? It's going to impact your risk premium and neutral rates in that economy.
Got you. Are there any particular elections that you're watching from the lens of your trading table?
Yes, watching the South African election very closely.
Gotcha.
Just a keen eye on that one. But I mean, I think when looking at the South African election, it feels quite binary. Analyzing it at the moment, 2 very binary outcomes that we're waiting for on coalition talks. Mm-hmm. But from a policy perspective, looking forward, you're actually probably in a less binary space.
Okay.
Thinking about the US election in November, the big one this year.
Yes.
There it's blue or red, and you can get very big policy shifts across those two outcomes, and that probably is one that investors should be focused on a lot more.
Thanks, Adam. As I began my introduction, I spoke about how debt levels have increased quite rapidly, particularly over the most recent period. And that's evident in advanced economies and emerging markets. And we've had some casualties fall out of that. I think in our own region, in Africa, there have been 3 debt defaults in the most recent period. I think Ethiopia, the most recent, there was Ghana before that, and then the first kind of chip to fall was Zambia, which is currently in the midst of a restructuring process. But the United States is running a debt-funded, by and large, budget deficit of over 6%. It's quite large. And I often wonder myself, is there a danger that deficit party is going to come to an end because people will not take up all the paper that's required to close that gap between the spending and the revenue that's available? Kieran, what's your thought? Do you think that the demand for U.S. Treasuries is going to kind of sustain itself, or do you think it's going to sputter out a bit?
Thanks, great question. One I love to try and answer. The advantage that the US has is that there are so many potential buyers for their bonds, and different constituencies can be buyers or sellers or holders at any one time. So I think the idea of there being a sudden stop, in, say, even the next 10 years, where there's a complete buyer's strike for US Treasuries, seems to me to be quite low probability. But having said that, that doesn't mean that the balance of buyers and sellers, including, of course, the government itself, who's the biggest seller, whether that can't affect the price, and the price both of US Treasuries and of the dollar. I think some of the kind of waymarks that are coming up over the next couple of years, in 2025 is when the first of the 5-year notes that were issued during COVID, which of course were issued in massive size, when they start to mature. And in that year, so next year, then if the US is intending to run a $1.8 trillion deficit or net financing requirement, then the amount of gross financing is going to need to increase a lot because those 5-year notes are coming due. And so it is, of course, possible that will put more upward pressure on rates. And I think the other thing about that transition from the old 5-year notes to the new whatever gets issued that is important is that the cost is to the Treasury of issuing that debt is going to jump a lot. And that matters more for the long term, the R minus G, which the US is usually on the right side of, that growth is faster than real interest rates. But that is clearly something that doesn't help the long-term projections. I think the other thing that increase in the cost of debt financing for the US government in particular, and maybe later the corporate sector, because I think the corporate sector issued at longer duration during COVID than the US government did, is that it affects the balance of income between US's overseas assets and the US debt that it owes to overseas. And that swing is something that eventually I think can put pressure on the US dollar, and you'll see the amount of debt that the rest of the world has to finance on behalf of the US government will fall in size compared to the rest of the world's GDP because the dollar is going down, and so foreign currencies will by definition more treasuries. So I think that's the process that we'll go through, and probably if the US budget deficit is still large or even larger, maybe in a couple of years' time, then that will be something that continues to put upward pressure on interest rates. aware that I'm going on. I mean, I think if there is a recession, then, the supply of other fixed income assets from the US will fall, and that makes more room for the government to issue. So a recession might well make it easier to do it at a lower price. Obviously, Fed is going to be cutting rates if there's a recession too. So that will change things.
Do you want to add?
Do you mind if I add from a South African perspective? Because when because Kieran mentioned the R-G, and when you look at it from an emerging market versus developed market economies, obviously developed markets have such bigger debt percentages.
Indeed.
And in emerging markets, the problem is, and a couple of years ago, in South Africa, when we were talking about how South Africa's debt levels were going to 75%, we were talking about when does the IMF step in? So when do they save us or come and rescue or take over control of the finances of the country? And it's pretty well known that I think it's pretty much consensus that South Africa's debt level is probably going to hit closer to 80% in 2027. But that conversation about the IMF bailing us out or taking over our finances has now actually stopped. And this happened actually before we had a great phenomenon, or something happened during our budget speech. We accessed what we called the Jafekra account.
Yes.
Yeah, so which stands for gold.
Foreign exchange.
Yeah.
Reconciliation.
Account, whatever.
Yeah,
contingency account.
Yeah, contingency
right?
account.
So we all just know it as Jafekra.
Jafekra, yeah.
And we took 150 billion rand out of that, and that's to help us reduce our interest payments and obviously help us kind of with cash flow, I guess, at the end of the day. And so your question around, will this party come to an end? Will the music stop? I think historically it has been a concern for South African investors, but somehow it hasn't. And also you can see it in our CDS. So our CDS, which is the insurance...
Credit default swaps.
That's right.
Yes.
People are not... Our 5-year swap, for example, is only like 250, somewhere around there, which is very low compared to other emerging markets. So it's as if the market is not pricing in a South African default, and that they don't think the party is going to come to an end. That people will continue to buy and support South African bonds and the government.
So Amapiano will continue playing for a while here.
For a while still.
And whatever the right tune is for the United States is going to continue as well, right? Very interesting. But I mean, to your point, Anthea, I think that certain markets have latitude that others don't, both in terms of the debt levels they can carry and what they can do with that debt and so on and so forth. There are a number of standards at play, I suppose, manifesting themselves in capital markets. And I think that's a good segue for the next piece. And I'd like to bring this to you, Bassam. Are there particular markets, whether they be advanced economies or emerging markets? So, for example, there was that very unfortunate acronym which was thrown around not that long ago about the pigs in Europe. Portugal, Italy, I think Greece and Spain. Yeah. I think Italy it's been doing pretty well relative to the rest of the European economies. I think tourism has come back, but it carries a very high debt load. Yeah. And it's the third largest, as far as I know, kind of debt market in the world. If that goes pop, it will not just stay in Milan or wherever. It will ripple out across the global economy. But are there potential fragilities in the sovereign debt market in particular that we should be watching very closely, or at least keeping a bit of an eye on?
Yeah. Well, at Alpine Macro, we wouldn't characterize ourselves as being concerned about a contagion in the sovereign bond markets. But for sure, there are always these pockets of vulnerability. And we can run down the usual suspects. So if we think about the JGB market, the thing with Japan is just that economy has way too much private savings. So the chances of a bond market riot in Japan is quite low. And then you mentioned the pigs. We can talk about those Euro area periphery bonds. But then again, those periphery countries, a lot of people don't realize, they've made great strides in actually reducing their external and fiscal imbalances. Their debt sustainability is much more improved. And the ECB, as you mentioned, is starting an easing cycle. So that actually cuts into the risk. Then we can speak about UK, for example. And if the incoming Labour government, if they pursue trust-like policies, then yeah, we can get another gilt market meltdown. But is it reasonable to assume that they would follow down that path so quickly after the debacle of late 2022? Probably not.
We're ahead of lettuce, outlasted Liz Truss, yes.
Exactly. And then obviously we have to consider the EM market, but even here we're rather sanguine for a few reasons. So number one, the dollar is stretched. Number two, the tightening cycle in the US is pretty much over. And number three, the fundamentals in the EM index, they're much improved. So they have much smaller current account deficits than they have in the past. Their inflation rates are not much higher than in the advanced economies, and they're building up more sufficient reserves.
Okay, so nothing too much to worry about. The signs are pointing in a positive direction.
I would say so, yes.
Okay. Let's talk about South Africa a bit more.
Okay.
And I'm looking at you, Anthea, because I think I want you to address this one.
Because I'm the South African on the panel.
Well, no, Adam's a South African.
Oh, yes, of course. Sorry, Adam.
So we were having some conversations earlier, and in those conversations, one of the issues that was raised is that within fixed income portfolios among local managers, the bias seems to be tilting towards non-South African fixed income assets, to global, other jurisdictions' assets. And you manage money on behalf of clients. So have you noticed this trend in general? And how are you engaging clients, broadly speaking? I know it will depend on the idiosyncratic scenario, but in line with this, are you kind of pushing more into global fixed income assets or biasing it towards domestic fixed income assets?
So the first part of the question about where the bias is going and how money is flowing offshore, I'm not sure that's a market question in South Africa or market-related answer as it is regulatory. So we had Regulation 28 changes, and everybody felt it was safer to be invested offshore, and so they took their big portion of money offshore. And so you saw quite a bit of South African investments flowing offshore to the point where I think a lot of funds are now to their limit on offshore investments. But from an investment market perspective, where do I even start? I think you'd be hard-pressed to find a 12% yield anywhere. And maybe we should take this back to basics and fixed income, right? So you have two issues in fixed income when you're investing. You've got your possibility of default risk, and then you've got your mark-to-market volatility.
Okay.
If you were just a buy and hold manager, you would know upfront what your yield was going to be. And so there's your 12%. You buy the bond, you get 12% at the end of it. And as I said earlier on, I don't suspect that South African government's going to default on their debt. If you're taking money offshore, the risks are increased by currency, right?
Yeah.
And so for foreign investors, that's the problem. So where are they going to go, and what are they looking for, or kind of for their purchasing power, and what happens to the currency?
Yep.
And again, there's two elements to this. There's the capital and the interest. So if you had bought bonds about 4 years ago, I think you were probably getting, let's say you were getting 8% per annum, and that's 4 years ago, but then your currency depreciated by more than that. So if you were a foreign buyer at that stage, you were actually now probably in a position of losing money. So even though I say, great, let's buy 12% yielding bonds, you do have to take that into account, I think. Yeah.
Gotcha.
So sorry, Herman. And then the question, I guess, is what are we advising our clients? And mostly our clients tell us what to do, strangely.
And what are they saying?
So a lot of South Africans are wanting offshore exposure. But again, it's where your assets are, where your liabilities sit, and if you're prepared to take the currency risk, you know, because you're not going to get 12% overseas. You're not going to get 12% in dollars.
Not at all.
And so we say it's fine. And what's been interesting about recently in the bond market is there has been an outflow, a net outflow of foreign investors into our bond market. So over kind of the 5-year period, it's a net outflow. But in the last year, and even in the last year to date, in the last 5 months, there's been net inflow of foreign buyers, of South African bonds, which tells you something. They do like the 12% yields. They're not too concerned about currency. And if they want to hedge out currency risk, which is quite expensive actually, then I guess they're just doing that.
Gotcha. Okay. In many ways, the world can be defined kind of pre-pandemic, post-pandemic. I suppose you can also stack it up in different ways. But when I look at GDP growth forecasts going forward, by and large now they are much lower, albeit you take away the two outliers. So we had a once-in-a-century pandemic, which introduced demand and supply-side shocks into the global economy, causing the worst recession in 80 years. Due to the marvels of science and the actions of institutions, central banks and governments to kind of push against that tide and protect lives and livelihoods, we had a significant bounce back in 2021. I think global growth averaged around 6%, if memory serves me correct. But now if we look kind of 2022 over the medium term, and I'm defining medium term to around 2027, the average growth rate in GDP expected over that period is lower than it was before the pandemic and after the global financial crisis. So we've seemed to found a new floor or ceiling to GDP growth. Inversely or conversely, what we're seeing with inflation is that it's stepped up for a range of different reasons, which I'm sure would have been discussed, but it had been discussed earlier. Fortunately, there's disinflation, but we shouldn't expect the low inflationary environment that we had 2017 to 2019. And in fact, when the Canadian governor was giving his statement yesterday after the announcement of the rate cut, he basically gave that particular indication. So my position is that we're on a path where inflation has step change to a new level, higher. And I'd like to know, and I think, Kieran, I'd like you to come in here, what implications does that have for the way one should approach fixed income investment in general and its role in your portfolio?
Yeah, so I guess I'm not completely sold on the idea that we're going to have a serious amount of inflation for a long period, and it's because the growth issue that you brought up. So, obviously you can get higher inflation at lower rates of growth if you've had a big hit to capacity. And clearly during COVID we had a huge hit to capacity to produce, but I think a lot of that has worked its way back in. So we have got supply, and in goods markets in particular, we see an oversupply coming mainly out of China. That's putting downward pressure on goods. So what we're seeing in inflation at the moment is the service sector is still showing that there is inflation. And I think a lot of this inflation is because relative prices are catching up. Workers are trying to claw back what they lost in real terms during the pandemic as goods prices soared. And so, maybe it'll take a few years to work out of the system, but without demand growth, I don't think we're going to have like 20 years of inflation. Now, I guess we come back to fiscal, and whether fiscal in the US can keep spurring demand growth for the next 10 years, then maybe that's something that would make me rethink on it. In terms of what it means for portfolios and fixed income investing in particular, I mean, one thing that we always think is you want to make sure you're at least earning the highest real yield possible in your fixed income portfolio, and you want to be able to preserve the purchasing power that you have. So, I invest in countries all over the world in different currencies, different rates of inflation, different levels of interest rates. And we care about the relative price levels between countries. So, a country which is exceptionally cheap to operate in, we would, prefer to buy bonds there at the same yield as somewhere where it's very, very expensive to operate in, and to consume a basket of goods. Because, most likely over time there will be some currency compression between those two. But basically you want to make sure that you're not giving up real return, which is, what your purchasing power is. And if we have another 3 to 5 years of service sector inflation being well above inflation targets, then that's something that we all need to be very, very mindful of when we're making those allocations.
Interesting. Okay, thanks for that. I read a recent article in the FT, and it was highlighting that there's an increasing risk in the US market in particular of companies in that $9 trillion corporate debt market losing their high investment grade rating. So net, if you have people moving from junk into investment grade and vice versa, the net is towards the vice versa, moving from investment grade into junk territory. What's your take on the health of the corporate? I use that as an introduction to ask, what's your your take on the health of the corporate bond market? And Adam, I'd like to ask you to address that.
Yeah, so the U.S. corporate bond market, we are noticing any systemic issues in terms of credit metrics or credit health in that market. I think an interesting sector of the market is the banking sector, and we've had some isolated instances in SVB and New York Community Bank that did have isolated levels of stress due to the higher levels of interest rates. What we've seen, I think, speaks to the regulation that's been put in place in the banking system post the global financial crisis has allowed these events to continue, quite in that isolated manner and preserve, the capitalization of the entire banking system and carry on as usual. Regarding the rest of the market, we're seeing, corporates have fixed in over longer periods, borrowing at lower levels, and are likely to be able to continue to refinance with spreads at quite attractively low levels and continue to operate with not significant impact on margins.
Thanks. And I'd like to ask everyone just to give a quick view on what sectors in particular you're bullish on. I suppose other than Adam, because you did give us a bit of an answer there, and what you might be bearish on in the corporate realm as opposed to the sovereign realm, to the extent that you could separate them. Anthea, let me start with you.
Sure. So from a fixed income perspective, I'm quite sector agnostic. I don't it's all about cash flow and the issuer.
Okay.
But if you're looking at equities, I think you'll probably see continued growth in innovation and technology and healthcare. I'd say those were the two sectors globally that are front of mind at the moment.
Yep.
Locally, I really do like our banks and retailers from a sector perspective.
Okay.
But our banks in South Africa have always been really good, well capitalized, well run.
Yeah. Absolutely. Bassam?
Yeah, for us, the sectors that we like are basic materials and tech as well. They have very strong cyclical indicators, and the ones that we do not like are transportation and consumer durables. We think they have poor valuation.
Oh, wow, interesting. I suppose Boeing might agree with you right now. Anyway, Kieran?
So that statistic at the beginning that you quoted, I think there are 3 companies, and Boeing is one of them, that are very big debt issuers that are at risk of downgrade.
Yes.
And it's, I think the other 2 are Charter Communications and Paramount, believe it or not.
What does Paramount do?
I think the media.
Oh, that one. Okay.
Yeah.
Yep. Okay.
So yeah, in terms of what we like in the US, we like banks too. You still get a spread pickup to own banks over the healthier bits of the corporate sector.
Can I so when you say banks, are you referring to kind of the headline banks, like the Bank of America's, the Citibanks, or more like your regional banks that have had a rough patch?
Yeah,
right
for
now?
us, it's more the headline banks than the regional ones.
Okay.
But yeah, that's a sector that we like, and one that we're avoiding in the US is REITs, which I think is another sector that maybe is helping to push up that number at risk of downgrades. And there's well publicized issues in the commercial real estate market in the US. I mean, globally, and I would say this because it's what I do, but we quite like EM local currency debt. I mean, it's something that we're quite keen to add to again recently. I mean, basically, monetary policy in emerging markets really kind of fed off the US in terms of what's priced over the last 2-3 months. At the same time when the credit markets for sovereigns have told us that EMs have become less risky. And that dichotomy looks a bit strange to us because inflation in EM countries has actually has not particularly pushed higher. There are 1 or 2 markets where like service price inflation has looked high, but it's skewed a lot by Latin America, which is really seasonal for service price inflation because everyone goes back to school and university in January and prices go up. And I'm sure there's some of that in South Africa as well. Maybe the data seasonally adjusted is a little bit better.
Great, thanks, Kieran. So I know you all have been briefed because I do have a question or two here. We might have an opportunity to get more than one in, but one has come in, and I'll let whoever raises his or her hand quickest take a bite at the cherry. So a question from Anonymous is, have the risks of a global recession been mitigated or eliminated? Who would like to give that a stab?
We would say they've been mitigated.
Yep.
Most of the world is coming out of a technical recession. Europe is coming out of an energy crisis for the last 2 years.
Yep.
We see that China is starting to turn a corner. It's actually performing better than what most people perceive. And we're sensing that policymakers, they have a lot more urgency in reflating that economy.
Yep.
And then obviously, the US is firing on all cylinders. Will it continue to do so? Probably not. It will probably decelerate back to trend. But the risk of a precipitous downturn, a recession, at Alpine Macro, we don't believe that that's a high risk at this point. So
may I?
Yeah, of course.
So, I mean, as I said, service sector inflation is high because people's incomes have been going up. Service providers have been demanding higher incomes. You get a higher income, you spend it. Consumption is, most of global GDP, and even more so in the biggest economy in the world. So, as long as incomes and real incomes are recovering, it's pretty unlikely that we get a recession in the short term, in my view.
Yeah, I think I'd agree. I don't know if anyone else has anything to...
I think you'd be brave to say that all risk of recession has been completely eliminated.
Of course.
And of course, from a South African perspective, we're looking at GDP growth of less than 1% for this year, which kind of leaves you very much on the border and concerned about what's going on. And the story with inflation in South Africa, and I know we spoke earlier about how we had priced in 3 rate cuts for the year, and now that's all but disappeared.
Yep.
And then there's no GDP growth. And the other part of it is that even though I'd say the market or commentators perhaps were looking for rate cuts, I think it would have been hard for the Reserve Bank to cut interest rates when we hadn't reached our inflation target. It doesn't make sense. I think the Reserve Bank would have lost credibility. And so at the beginning of the year, in fact, at Cartesian, we were talking about potentially more rate hikes this year. And it's not the Reserve Bank's mandate to look after GDP growth or financial stability is theirs.
Yeah.
But so would they have increased interest rates, knowing that our GDP growth is so precarious? luckily for us, the US didn't, you know. So everyone says that we follow them, and so we didn't have to. But I would say with inflation still above 5% and our target at 4.5%, and the governor talking about lowering the inflation rate, it's not completely off the cards that we could go into recession because of higher interest rates.
Let's hope that the Reserve Bank governor is able to follow the lead of what's anticipated out of the Federal Reserve with at least one cut this year. But it's come to the end of our segment. Incredible insights. I've certainly taken note that whether it's Amapiano or country music, Beyoncé's latest tune, the party will continue. The relative ability of governments, in particular amongst others, to carry the increased debt levels has improved. And very much took note, Anthea, of the comment that you made that there's still appetite for South African paper, which bodes well. I think if investors weren't willing to come in, we'd really have things to worry about. But thank you, gentlemen and lady, for your time and perspective. And I'd like to give them a round of applause. And thank you for your questions.